Your bank is watching every deposit you make, and HMRC has a tool that lets it see your account without telling you first. That tool is called a Financial Institution Notice. It has existed since 2021, and the number of times HMRC used it went up again last year, reaching 1,307 notices issued between April 2024 and March 2025 alone. Most people in this country have no idea that power exists, and more importantly, no idea what kind of deposits trigger it. That gap in knowledge costs people money, not because they have done anything wrong, but because they do not understand how the system reads what they do. By the time you finish watching this, you will. The entire legal framework for how banks monitor your money comes from one piece of legislation, the Proceeds of Crime Act 2002, which professionals call POCA. Under POCA, every bank, building society, solicitor, accountant, and anyone else operating in what the law calls the regulated sector carries a legal duty. If they know, suspect, or have reasonable grounds to suspect that money passing through their hands might be the proceeds of crime, they must report it. And here is the part that catches people off guard. They do not report it to HMRC. They do not report it to the police directly. They report it to the National Crime Agency through something called a Suspicious Activity Report, a SAR. In the year running from April 2023 to March 2024, over 900,000 SARs were filed in this country. That number does not represent 900,000 criminals. The overwhelming majority of those reports go absolutely nowhere, sitting in a database as background intelligence. No frozen account, no letter, no knock at the door. But around 15% of those SARs did result in further investigation by the NCA or HMRC, and the total value of funds blocked because of SAR intelligence exceeded £300 million in a single reporting period. What triggers a SAR is not the size of a deposit on its own. There is no magic number in the United Kingdom, the way there is in the United States, where banks must file an automatic report the moment you cross $10,000 in cash. That American rule does not exist here. A SAR can be filed on a £200 transaction if the behaviour around it looks wrong, and a perfectly explained deposit of £50,000 might generate nothing at all. The system is not watching for amounts. It is watching for patterns. The single behaviour that draws the most attention from bank monitoring software has a name. It is called structuring, and it is the reason good people with clean money end up with frozen accounts and solicitor bills. Structuring means taking a sum of money and deliberately breaking it into smaller deposits to avoid drawing attention. 3,000 on Monday, 2,000 the following Thursday, another 2.5 the week after, perhaps at a different branch or through the post office to vary the pattern. The person doing this almost always believes they are being sensible, cautious, even responsible. What the software sees is textbook criminal behavior. The pattern recognition systems these banks run are sophisticated, and they are built to identify exactly this shape of activity. The crucial problem is that those systems cannot distinguish between someone laundering drug money and someone who sold a caravan and got nervous about paying it all in at once. The software sees behavior, not intention. It has no way of knowing why the deposits look the way they do, and that is why spreading a sum out over time is, counterintuitively, far more dangerous than paying it in all at once. A single deposit, even a large one, with a clear explanation and a piece of paper to back it up, is the most boring thing in the world to the people doing the watching. A series of similar deposits over several weeks at varying amounts and locations is the shape the system hunts for. Now let's separate the two systems, because people frequently confuse bank monitoring with HMRC's own powers, and conflating them leads to bad decisions. The Suspicious Activity Report system, run by the NCA, and the tools HMRC uses to access your financial records are different things, governed by different legislation, and they can operate entirely independently of each other. HMRC's most significant and least understood tool is the Financial Institution Notice, known as a FIN. The FIN was introduced by the Finance Act 2021 and it gives HMRC the power to go directly to your bank and demand your financial records for a named taxpayer. No tribunal approval, no requirement to inform you first. The bank receives the notice and must comply within 30 days, with a penalty of up to £1,000 if it fails to do so. In the reporting year from April 2024 to March 2025, HMRC issued 1,307 of these notices, up from 1,143 the previous year, and the trajectory is rising. To put that in proportion, HMRC conducted 316,000 compliance checks in the same period. So FINs remain a targeted tool rather than a routine one. But the number is growing and the direction of travel is clear. Running alongside FINs is something called the Connect system, HMRC's internal data matching software. Connect cross-references your tax return against data from your banks, the land registry, the DVLA, and since January 2024, online platforms including eBay, Vinted, Etsy, and Airbnb. Those platforms now report seller earnings above certain thresholds to HMRC automatically, whether the seller declares that income or not. If you report £28,000 in income, but your bank shows £60,000 in deposits, Connect flags the discrepancy. If you declare modest earnings but drive a car that appears on the DVLA's register for a vehicle worth considerably more, Connect may flag that too. HMRC does not need to ask for your permission, and it does not need to tell you it is looking. The most serious outcome in the cash monitoring system is not a letter from HMRC. It is something called an account freezing order, and it arrived in the legislation under the Criminal Finances Act 2017. An account freezing order, an AFO, allows an enforcement officer from the NCA, the police or HMRC to apply to a magistrate's court to freeze the money in your bank account. Not the High Court, not a senior judge weighing complex financial evidence. A magistrate's court. The balance in the account only needs to be above £1,000. The legal threshold the enforcement officer must meet is merely reasonable grounds to suspect that the money may be recoverable, meaning it might represent the proceeds of unlawful conduct. No arrest is required, no charge is required, no conviction is required. And the application can be made without telling you. The first you are likely to know about an AFO is when your debit card is declined at a supermarket checkout. When you ring the bank to find out why, the person on the other end of the phone cannot tell you. That silence is not customer service failure, it is a legal obligation. Section 333A of the Proceeds of Crime Act 2002 created the offence of tipping off. If a bank employee tells a customer that a suspicious activity report has been raised or that an investigation is underway, that employee has committed a criminal offence carrying up to 5 years in prison, the lovely person on the helpline who can hear the distress in your voice is legally gagged. They are not being unhelpful. They are not permitted to help even if they want to. 2 rounds of regulatory changes have moved the ground under people's feet in the past year or so, and both of them matter for anyone who uses cash. The first came from the Financial Conduct Authority. The FCA identified that hundreds of millions of pounds were being laundered every year through cash deposit services at the post office. That estimate came from the National Economic Crime Centre. In response, the FCA pushed banks to introduce hard limits on how much cash personal account holders can deposit. From 1st July 2024, Barclays introduced an annual cap of £20,000 on personal cash deposits, resetting every January. The FCA's own guidance proposed a daily limit of £1,000 at post office counters for personal accounts, and an annual limit of £10,000. That £1,000 daily figure was not chosen at random. It matches exactly the minimum amount that law enforcement is permitted to seize under the Proceeds of Crime Act. Banks are also now expected to move away from paper paying in slips and toward card-based transactions at post office counters, specifically to improve their ability to monitor who is depositing what and where. If your bank previously allowed you to use a paying-in slip at the post office with a fairly large sum, that option may no longer be available or may now come with tighter scrutiny than before. The second change works in your favour. From April 2024, Banks became obligated to give customers proper notice and a clear reason before closing an account, with limited exceptions where an active criminal investigation makes disclosure impossible. For years before this, people had accounts shut with no warning and no explanation. That still happens in specific circumstances, but the bare minimum protection, knowing that a closure is coming and why, is now a right rather than a courtesy. And from 31st July 2025, under amendments introduced by the Economic Crime and Corporate Transparency Act 2023, the poker threshold amount for deposit-taking bodies rose from £250 to £3,000. What this means in practice is that banks can handle lower value transactions in the course of operating your account or ending a business relationship without needing to apply for special consent from the NCA, even where criminal activity is suspected. The intent is to reduce the volume of low-value SARs clogging the system so that resources can concentrate on higher value activity. It does not reduce the bank's duty to report suspicious behavior. It simply raises the floor at which a specific type of consent is required. All of this resolves into 3 practical rules, and the first one will feel backwards until you understand why it works. Rule 1. Deposit the full amount in a single transaction. The instinct most people have, to spread a large sum across several deposits to keep things quiet, is the exact behavior the system is designed to catch. A single deposit, however large, accompanied by a simple explanation and a document, is almost always unremarkable. A series of similar deposits broken across multiple days, weeks, or locations looks, to the monitoring software, like structuring, regardless of where the money actually came from. If you have sold a car for £9,000, pay the entire £9,000 in on one occasion. If you have received a gift from a family member, pay it in as a single amount. If you are consolidating savings from one bank to another, move it in one clean transfer where you can, and keep both the outgoing and incoming statements along with the transfer confirmation. Rule 2. Your paperwork is your shield. Every situation where a large sum legitimately enters your account has a document that proves it. For a private sale, that is the bill of sale. Your name, the buyer's name, the date, the amount, the item, both signatures. For a family gift, that is a simple note from the giver stating the amount, the date, and confirming it is a gift with no expectation of repayment. For an inheritance, it is a copy of the grant of probate or a letter from the solicitor handling the estate. For a pension lump sum or insurance payout, it is the provider's statement. These documents do not need to be formal. A handwritten note with a date and a signature does the job. File them somewhere you can find them quickly, paper or digital, and keep them for at least 7 years. Rule 3. When the cashier asks, say one sentence and show the paper. Bank staff are trained to ask about the source of large cash deposits. This is not personal and it is not an accusation. The correct response is short, calm and honest. I sold my car privately, or it is a gift from my daughter, or I am consolidating savings. One sentence, then hand over whatever document backs it up. What you must never do is ramble. A long, anxious account reads very differently on a file than a calm single statement. And never, under any circumstances, say anything that implies awareness of limits or a desire to avoid them. Phrases like, I did not want to go over any threshold, or is there a way to do this without it being flagged, can end up written into the very report you are trying to avoid, because they sound like someone who understands the rules and is trying to work around them. If a cashier ever offers to break the amount into smaller deposits to make things easier, the answer is always no. Let's work through the situations where this comes up most often in ordinary life, because each one has its own nuance. Selling something valuable for cash, a car, a motorbike, a caravan, a piece of jewellery. Private sales for cash are completely normal and completely legal. The only things you need are the bill of sale and the willingness to pay the full amount in a single deposit. Keep a photograph of the item and a record of the buyer's name if you can. That is your complete protection. A gift from family. In the UK, receiving a gift is not taxable income for the recipient. You do not declare it. You do not pay income tax on it. The only tax question that ever arises from a gift is on the giver's side, specifically whether inheritance tax applies if the giver dies within 7 years. Even then, the liability falls on the estate, not on the person who received the gift. So if your son gives you £8,000 in cash for a significant birthday, you pay it in as a single deposit. You keep a short note from him confirming it is a gift and the date it was given, and there is nothing further to do. Moving your own money, moving savings between banks or consolidating accounts after bereavement is the scenario I find most upsetting, because it catches people who are already carrying a great deal. The money is yours, tax was paid on it years ago. And yet, if you move it across in installments over several weeks, the pattern recognition software sees structuring just as readily as it would for laundered cash. Move it as a single bank-to-bank transfer, where the account limit allows it. Keep both sets of statements, and if you must split the movement for practical reasons, document each part clearly and do it over as short a time frame as possible. An inheritance tax, where it applies at all, is settled by the estate before anything reaches the beneficiaries. The money arriving in your hands has already been through that process. If it comes by bank transfer, the solicitor's records provide the paper trail. If it arrives as cash for any reason, treat it exactly as you would a private sale. Single deposit, grant of probate or solicitor's letter as your supporting document. A large legitimate lump sum, a pension payment, insurance payout or compensation. The provider holds the records, the bank holds the records, and everything matches. The mistake people make is to panic at a large balance and start shuffling it into smaller pots, which is precisely the behavior that generates scrutiny. Leave it where it lands, keep the provider's statement, and do nothing that creates a pattern where there was none. If you ever receive a letter from an enforcement agency or your account is frozen, or someone contacts you about your banking activity, there is one rule above all others. Do not try to explain yourself on the spot. Do not sign anything. Do not answer detailed questions in a panic. However certain you are that the whole thing is a misunderstanding, and however much you want to clear it up immediately. Say one thing that you would like to take advice before responding. Then find a solicitor who works specifically in proceeds of crime and financial matters. The instinct to immediately prove your innocence by talking is completely natural. And in these situations, it is almost always a mistake. The people on the other side of these conversations are trained. You are not. Get proper help first. This week, before you do anything else related to this topic, start a folder, physical, digital, or both, and call it something simple like money, where it came from. From this point on, every time a meaningful sum arrives in your account, anything above a few £1,000s, put 3 things in it. A single line in your own handwriting or typed, stating the amount, the source, and the date. The document that proves it, whether that is a bill of sale, a gift note, a probate letter, or a pension statement, and the bank statement or transfer confirmation showing the money going in. That folder is your complete defense in any future questioning. The overwhelming probability is that you will never need it. But if someone ever queries a deposit from 3 years ago, having that folder means the matter resolves in minutes rather than months. People who keep their records clean and their deposits whole are the people who sleep soundly, not because the system cannot touch them, but because when it looks, it finds nothing that needs explaining. Clean money, clean paperwork, moving in plain sight is the most boring thing in the world to the people doing the watching. And in this particular area, being boring is exactly what you want to be. The rules covered here, POCASARS, Financial Institution Notices, Account Freezing Orders, the new FCA deposit limits, none of them exist to make life harder for honest people. They exist to catch dirty money moving through the system. The problem is that the software enforcing them cannot read minds. It reads patterns. And the patterns that trigger it are the same patterns that well-meaning people fall into when they are trying to be careful. Understanding this does not make you a target. It makes you the kind of person who never becomes one. If this helped you make sense of something you had been wondering about, share it with someone who would benefit from knowing. A parent who is about to sell a car, a friend who is consolidating savings after a bereavement, anyone who keeps cash at home and is thinking about banking it. The information costs nothing to pass on, and it genuinely can save someone a great deal of stress.